For the month of June, how did the survey look?
Cindy, our survey of supply managers in 9 states, that's stretching from North Dakota and Minnesota in the north to Arkansas and Oklahoma in the south, that index, it's weakened a little bit, but it's still very strong. This economy, at least our leading economic indicator, is pointing to growth in the months ahead. So we're a little at variance with some of the national gloom and doom reports. Our report was pretty positive this month. So again, is this part of the country an outlier? I don't think so. I just think the gloom and doom at the national level is a little overdone right now, at least in my judgment.
What about employment? I mean, that is something that people are looking at, and that's where part of that comes from.
Absolutely, Cindy, and our employment looks good. Now, of course, we're oversampling manufacturing, and manufacturing is doing quite well. Building up of inventories continues. So it is correct that when we say, well, the consumer has not begun to buy, to spend, and so on. But I think just have a little patience, folks. This is a recovery. If we'll not get so impatient and try to pull the trigger on more government spending, another stimulus package, I think we're okay here. Again, but will we be patient? I don't think so. In other words, we're going to see some action. Sometimes no action is the best course. I think no action in this case is what's called for, but we'll get some action, unfortunately.
No, but the employment index itself, I mean, people are still seeing what are considered high numbers.
Oh, absolutely. And of course, some of the employment numbers at the national level and even this part of the country is being driven by the census workers hiring a lot of government workers, and those individuals obviously are temporary, so the employment numbers will fall back sometime in the months ahead. So there is some froth in the numbers, of course, and there's froth in our numbers as well. In other words, we're going to see growth being a little more tamed in the months ahead than what we've seen in the previous, say, 6 months.
What's been in the news a lot is the market in Europe.
Right.
What's happening there, and how is that having an impact on us?
It is, Cindy, absolutely. You take the confidence number, it's not as strong as it was. Of course, the value of the dollar has been bid up against the euro especially. Now what that's done, the positive side is it's reduced inflationary pressures. Our inflation gauge took its biggest drop since October of 2008. Still too high, but took a huge drop. Now what's done, the European situation, what it has done is pushed up the value of the dollar, which has made our foreign goods coming into the U.S. less expensive. So that's pushed down inflationary pressures. Oil prices, for example, are, and maybe they're not great, but they've come down. That's looking better. So with the strength of the dollar, that does reduce inflationary pressures, and that's good. On the flip side, it hurts for our exports to Europe particularly. Now, our export numbers for the month were even there were strong, very strong, and that's probably going to weaken as the U.S. dollar strengthens, as it has strengthened. That again makes U.S. goods more expensive abroad, reduces exports. But all in all, trade remains, imports and exports remain very solid, at least according to our survey.
Do you still think the Fed is taking too much of a backstage right now?
I think they are. I think the Fed needs to step up, as I think the businesses in our survey are stepping up and saying this economic downturn is over and we are heading into growth. Now, unfortunately, there is a potential to drift back what we call a double dip recession. I think the likelihood there is maybe as high as 30%. What could produce the double dip recession is just so much uncertainty coming from our federal government and the Fed. Now the Fed, I think they've given us certainty in the sense that they're saying we're not going to raise interest rates. I think they should be raising rates. Rates are at the lowest level since the Fed was formed in 1913. They're at 0 to 1/4%. So they don't have any room to move lower on interest rates. I think they need to begin raising interest rates. I don't think it would cool the economy off to any significant extent. In fact, I think it would help the economy, giving us more certainty about where this economy is going. The Fed is, in my judgment, has been too silent, too long, and with interest rates too low for too long.
What else about the June numbers that you found interesting?
Well, we asked the supply managers about how they saw their pay increases over the next year, and there's been a fairly significant increase in individuals, workers that thought their pay would be reduced. Now it's still low, but still that's troubling, and that's part of the troubling picture, is that all workers are seeing their pay prospects not very good in the months ahead, not very good in the next year, and that's particularly the case for government workers. Now, we don't survey government workers, but nonetheless, the government, the state and local government, that's the real trouble. That's one of the huge, big, troubling points of the economy looking ahead, is what happens there when states begin to have to cut back, and they're going to have to cut back because tax collections are down, continue to be down. And as that spills over. So again, overall, looking ahead, growth that I expect for the next 6 months is not going to be as good as what we've just seen the past 6 months, but it's still positive. The real problem point for the economy is the uncertainty that we're seeing, the uncertainty about tax increases, uncertainty about cap and trade, uncertainty about what's going to happen in terms of the healthcare reform. All that is very troubling. And then finally, what's going on in Europe, and that's a real significant factor. Although again, I think all that is overdone, but it is what it is. I think it was again a good report, probably a lot better than what I expected. I think it's going to show up as a lot better than what a lot of people expected. We'll know this Friday when the BLS, Bureau of Labor Statistics, releases their employment numbers. I expect them not to be very good. Why? Because we're going to have the layoffs of the census workers, and the unemployment number is still troubling. It's still too high. 9.7 is probably going to go up to 9.8, 9.9, maybe even as high as 10%, although I don't think so. So the employment report this Friday is not going to be as good as our report, but our report is a leading economic indicator, produces a leading economic indicator. That's a lagging economic indicator, but it does have impact on expectations, has impacts on bond prices, has impacts on interest rates, and so on.